Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
We're starting off strong. Wei Li, Chief Investment Strategist at some firm. I think I've heard of it, BlackRock. I don't know, something or other. BlackRock, I think they do they manage some money there. We're going to chat with her and get her thoughts on these markets. Mark Valentino, head of business banking at Citizens Bank, on kind of Black Friday sales and kind of how they're shaping up and how the retail sales outlook is for the holiday season. Alyssa Rusinoff, Chief Executive Officer at LTech AI, on growing stress in the opaque private credit market. And we'll talk about that. Private credit, some people are a little bit concerned about what's going on there. Bloomberg Surveillance is brought to you by Cohn Resnick. With a new office in San Francisco, Cohn Resnick is expanding to help Bay Area businesses optimize performance and manage risk. Put their industry expertise to work for you. Wei Li joins us here, Global Chief Investment Strategist at BlackRock. Wei Li, 2025, boy, you just look at the numbers, the top line numbers. S&P up 15%, the NASDAQ up 20%. Fixed income give me high single-digit total returns. Pretty much a solid year for investors. How about 2026? How are you guys kind of framing 2026?
We have positive risk heading into 2026. Our outlook is called pushing limits, and it's really about making sense of large numbers being talked about, and what do we need to believe to justify this huge amount of AI spend. So currently, when we look at the incremental revenue of these big tech companies heading into 2030, end of this decade, they fall short of justifying this huge amount of capex. You know, we're talking about credible estimates pointing to $8 trillion of spend by 2030. Those are huge numbers. So right now the forecast falls short, but the potential of AI goes beyond existing business lines. So if we have a situation where growth breaks out from the historical 2% trend, never happened before for a sustained period, but now possible because of AI. And also if we have a situation where tech companies keep a good share of the additional revenues being created as tech is applied to other sectors, then the numbers can add up. But you got to believe in some pretty incredible and unprecedented things to justify this unprecedented amount of capex spent.
I'm looking at the Bloomberg Mag 7 Total Return Index, up about 24% so far this year. Are you expecting this same caliber of returns to continue into next year? Do you expect tech to be the leader as we look into 2026?
I do expect concentration first before broader diffusion. When we think about the AI trade, we're talking about an environment where there is going to be more leverage, there is going to be more scrutiny over the individual company fundamentals. So if you think about the latest correction in tech and more broadly in risk assets, actually you see greater differentiation, right? You see Alphabet doing better because of the model, Gemini 3 and TPU, and you see Oracle doing a bit worse because of negative free cash flow as well as greater indebtedness. So greater differentiation, concentration before broadening out, and I'm paying very close attention to if there are new revenues being created on top of existing business lines to really understand if the runway of AI is as big as people are hoping for.
If the AI expectations may be ahead of themselves at this stage, are you pulling back from some of those names here? Are you hedging some of that risk here at this point? Are you trying to diversify away from that a little bit?
Well, that's the thing. There is no place to hide. There is no proper diversification in this environment. So one of the key themes in our outlook is diversification mirage. We call it a mirage because the old diversifiers are not reliably working. And this last 24 hours of price action is case in point. So, you know, we look at a seemingly mixed diversified portfolio, and we think that it is proper diversification, but that would be highly misleading because the whole market is being driven by just a handful of singular principal components, and AI being one. So we can't get away from making big calls, active calls on where AI is heading towards, and investment decisions made in the guise of diversification may well end up being huge active bets. So let's make those bets very intentional ones rather than unintentional ones.
So when we think about AI and all the energy that's needed for this, it's going to need a lot of energy. How are you thinking about the energy sector right now?
There is a constraint that is binding already. So as we think about the AI ambition running up against constraints, which is why we frame the outlook on pushing limits, there are three types of limits. One is energy and the physical limit, and we're running up against those limits already. One is financing limit, and right now we actually don't see that being a constraint, because even though leverage is going higher and big tech, they have issued $100 million of debt just the last quarter, which is higher than previous years. The starting point is very healthy, right? So there is room to leverage up. There is a feature, is not a constraint at this moment. And then there is the political constraint. We're talking about impact of AI on jobs and what that means in terms of the policy response, regulatory response. So these are the constraints, but right now the one that is binding is energy. So when we talk about credible estimates taking CapEx forecast up to $8 trillion by the end of the decade, the consideration for energy may well bring that back.
So as we step back and think about 2026, I guess geopolitics, we have to think about that a little bit. We still have an active situation in Ukraine. The Mideast has been quiet for the last several months, but still doesn't feel like that's settled by any stretch of the imagination. Then we have ongoing tensions between the U.S. and China. But it seems like the market's kind of discounted all of that. And I mean, is that something we need to worry about for 2026? Because it seems like a black swan could come out of anywhere.
Yeah, so when we assess the impact of geopolitics on markets, we need to really firmly establish the transmission mechanism, right? So far, a lot of the geopolitical flare-ups have been good opportunity for market participants to buy the dip. And you look at how markets have done, that has been a good strategy. So if we see the impact of a geopolitical event having a lasting effect on oil price, for example, and then feeding through to inflation expectations, not just the 12-month expectations, but maybe even longer term expectations, then there is a proper feedback loop. But if we're talking about a very swift spike and then coming back down, then that's not something, at least from a longer term portfolio construction perspective, we bake that in. You look at geopolitical risk premium is very flat at the moment.
So when we think about geopolitics, what do you make of potential opportunities when we think about energy or defense, for that matter? I mean, we've been seeing a large bid in European defense.
That's right. So for Europe, so far this year, we have approached investing through a very selective way. We like industrials within that defense. We like utility, and we also like financials because of cheap valuations, as well as its potential to be disrupted by AI. So defense as a evergreen theme, especially given the commitment of NATO countries to increase their defense spending, that is structural. We think that there is definitely a place for strategic kind of allocation to this theme, but it has rounded up quite a lot in terms of price so far this year. So we're actually rotating within our European tactical asset allocation from industrials defense into healthcare as a sector that actually has great valuation opportunities, as well as also open and ripe for AI disruption. But strategically, definitely we want to have exposure to that, despite the geopolitical headlines, or because of geopolitical headlines, because the strategic direction of travel is very clear.
Wei Li, I love the BlackRock offices over in London. They were right next to our old Bloomberg offices in Finsbury Circus. Now we're over at Queen Victoria Street. But
not too far from your new office.
Not too far from the new office. A great part of town in the city of London. Love it, especially around this time of year. The city of London is just awesome. Wei Li, Global Chief Investment Strategist for BlackRock. Thanks so much for joining us. We appreciate it. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Meredith Whitney darkens the door here. She is the Chief Executive Officer of Meredith Whitney Advisory Group, longtime voice on Global Wall Street. Meredith, we're kind of right in the middle of the holiday shopping season. How do you think the consumer's doing out there?
Well, it seems as if the retail results have been idiosyncratic, but I can tell you what I've become very nervous about is what has powered the U.S. economy for the last 5 years, which is what I call the avocado toast generation. So it's between 24 and 38. So it's the older Gen Z and the younger millennials. And they've really hit a wall. They started to hit a wall this summer. So they've been powering spending at Chipotle, Sweet Greens. I mean, the idea of spending $20 for a salad or a burrito bowl. You don't see me in line at a Chipotle, but I'm not brown bagging it, but at any rate. So the restaurants started to talk about the fact that this demographic was really struggling because of the resumption of student debts. And we went further into that. And if you look at what the avocado toast generation have, they've actually amassed a lot of debt over the last 5 years. So they've got 28% of all consumer debt. They've got about $300 less or more into their spending. So we think about COVID stimulus as being a massive stimulus impact on the consumer. It was $814 billion. Student debt forbearance, $400 billion. So COVID stimulus went out to 165 million Americans. Debt forbearance went out to fewer than 40 million Americans, with 50% of the spending power. So this demographic had a massive amounts of discretionary spending power, and that's not going to come into the economy. And so I think you see names. I was surprised by Urban Outfitter being so strong, because that caters to a very avocado toasty type demographic. But I think you're going to see more and more pressure throughout this year and into next, because they have got a tremendous amount of debt, they have no equity, and they have no way out. And what's going to happen is this: the Treasury Department has this top program where it's going to garnish tax refunds, and the Department of Education is aggressive on the 20% serious delinquent and charged off loans. They're going to start pulling this back, and that's going to hurt them a lot. And obviously, we know the low end is really strained.
So what's the elasticity of this consumer group, which I would call the matcha generation?
Oh, that's actually,
that might pair with your avocado toast generation.
I think it works, or you could call the French press coffee generation.
Lots of options.
Yeah, it's true. The elasticity is going to come down to. I don't think there's a lot of elasticity with this demographic that has so much debt. So the debt gets worse. So the student debt is the one part of the economy that has the highest delinquencies, the highest charge-offs. I think that's going to bleed into auto lending, because the avocado toast generation owns 35% of the auto debt outstanding. So that's going to get crowded out. So you're going to see it factor in. The elasticity, I think, is really interesting in terms of one factor, like one trend that we've been tracking very closely has been home equity loan extraction. And that's been the fastest growing loan category of any consumer loan category. And that started in 2020, in earnest, the summer of 2024. And what's really interesting is, historically, that's home equity loan extractions have been used for home renovations, but now they're increasingly used for cash management. So since 2022, there's been over a 50% rise in home equity extractions use of cash management. Now, that is, every week we look at this. I pull it through Bloomberg, and it continues to accelerate. Now, it's only available for the prime market. So if you have any type of credit ding on your credit score, you can't access the equity in your home. But avocado toasters, by and large, don't own homes. So they have no equity to tap. And if they do own homes, they've got high LTVs, right? Because they haven't owned homes for that long. So they don't have much equity to tap. So that feeds into very little elasticity in this group. And then you think about when you look at 2026 and people get excited about one beautiful bill, tax refunds. Well, if you own a bunch of student debt, you're going to get tax refund garnishment. So I don't see, it's a great question. I don't see a lot of elasticity within this group. Now, that said, there's still so much money swashing through the system, but it's at the high end.
You know, this K-shaped economy, Meredith, is it something that's always been out there? Is it more pronounced in the last 10 or 15 years than it was in the past, do you think? Because it just seems like it's really pronounced these days.
Yeah, there's without a doubt, it's gotten so much more pronounced in the last, really since the great financial crisis. Yep. And, it's said by probably the most esteemed person in this building that you can have, wage, you can have income disparities, but when it reaches a breaking point, it's not good for society. And I think at this point it's reached a breaking point. So the BEA puts out numbers whereby you see who controls what amount of spending over the course of the years. And I've been going back to, early 2000s. And you can see in terms of spending how much the low end contributes and how much the high end contributes. And that's just been diverging. So the most recent number shows the bottom 40% contributes only 22% of spending, whereas the top 40 contribute 62%. That was much more, that wasn't equal, but it was much more even, let's say 17 years ago.
So in terms of the lower end consumer, where is the majority of their money going? I was hearing anecdotally, even during Black Friday sales, people were actually purchasing necessities.
Yeah. So I think tomorrow and Thursday, the dollar stores report, and I think that'll be a really good insight into the lower end. Now, Walmart is not the lower end. Walmart is everybody, and the shopping experience is just so spectacular that more and more people go to Walmart. But the dollar store, it's not exactly the case, but I always say people drive to Walmart and walk to the dollar stores. And the dollar stores may benefit because you've had consolidation at Party City and some of the things. So you may go and get, wrapping paper and birthday items. But on essentials, it's really catch as catch can. And I think surely people are going to be buying basic essentials. I think what's also interesting is because chains like McDonald's have offered more value and really captured the value meal, people are eating out more because it's cheaper to eat out than homes, and that always shifts. So for a while, when they were going away from the value meals, people were buying more essentials. It all depends, but I think it is clear that over 52% of households, probably a lot over 52% of households, are barely getting by.
Meredith, thank you so much for joining us. Meredith Whitney, Chief Executive Officer of Meredith Whitney Advisory Group, and Lawrenceville class of 87?
88, first class of girls to graduate.
First class of girls to graduate from the Lawrenceville School for 200 years as all boys. It was after my time, unfortunately, but it was a great thing because it was one of the greatest things that ever happened to Lawrenceville schools, having girls comes in, because the boys dress better. They sit up at their desk. There's no more screwing around because the girls came in. They were smarter than us.
Positive influence.
It was unbelievable. They lifted the school dramatically. It was the best decision the schools ever made. And I have to admit, Lawrenceville did it the right way. They invested in the school before the girls got there. So when the girls got there, I think they felt like they were part of the team there. So
the Carlisle Hotel, It was amazing. And they were so welcoming. It was just an incredible educational experience. And I loved it because if someone had a problem with someone, there's a pylon.
Yep, exactly right. Yeah. Meredith Whitney, thank you so much. We appreciate it. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Cameron Dawson joins us here in studio. Cameron, we've had a little bit of waffling in the market over the last several weeks. Is that just a little bit of... I don't know. We've had such a great run coming off the April lows that maybe we're just stepping back and reassessing here, or we have something different going on out there, do you think?
We would categorize this as a very healthy digestion, simply because we saw such a powerful rally, mostly in September and October, in some of the most speculative portions of the market. So to see some rationality come back in, we would see it as a good thing. The reality is that you are still rising GDP forecasts, you are still increasing EPS forecasts, which would tell us that this kind of correction and churn is more short and shallow versus something that's deeper and more protracted, which would come if you were cutting forecasts.
So, of course, we've just entered December. I'm really stopping from saying ho, 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 but we always talk about the Santa Claus rally, right? And this usually happens in the back half of December when we see a rally into year end. How are you thinking about that right now? Of course, it's December 2nd and we are seeing some shakiness, but what's your view?
Yeah, we've been thinking that if there was one thing that could bring Santa Claus to town, it would be positioning. And the fact that if you look at things like the Deutsche Bank Consolidated Positioning Index, it's still just right below neutral. And even discretionary investors are only in the 26th percentile.
So what is that? What's the consolidated positioning thing? What is that?
It's a Deutsche Bank index, and it's been very, very helpful in understanding when institutional investors are either all in the market or very short. It's one of the things that since the April lows, it actually got down to the first percentile. So we've been making the argument since that time that as long as investors were underweight this market, that dips would be bought because people would need to chase into the strength. And so that is the setup into year end, which is that the chase could be on, mostly because you also have the backdrop that EPS forecasts are still going up. So you have a fundamental reason for people to get longer this market.
Mm-hmm. What about, as we talk about dip buying, how are you thinking about retail traders right now in this environment?
That's an incredibly different story. Retail investors are all in. If you look at the AAII allocation, it's at 70.5%. That's the peak that we got to back in 2021, 2018, 2024, all times that were then followed by more market kind of weakness. You've also seen a lot of growth in FINRA margin loan balances. They were growing at a pace of 35% over the last 6 months. To put that into context, going back to 2020, we were only growing at a pace of 30%. So you actually have margin loans growing faster today than they did at a time when rates were near zero. So what you have seen is households move into a full risk on allocation, whereas institutions have much more sat on the sidelines.
Do we like that? Do we like the retailers getting in there?
So look, it clearly we're seeing the perils of high leverage and getting unwound, mostly in things like the crypto space. There was a great article on the terminal this morning talking about how some of these leveraged ETFs to things like strategy are down 80, 90%. And so clearly there are signs that there was a lot of froth and a lot of speculation that was going on in certain cohorts of retail traders. You had an article in the Journal yesterday talking about how servicemen in the U.S. are trading stocks. And so, is this the same as the shoe shine person telling you stock tips back in 1929? Not so sure. But clearly there has been a speculative fervor in certain pockets of the market.
So speculative fervor definitely in focus here, but how are you thinking about defensive sectors, say maybe healthcare, utilities?
Yeah, it's interesting. There's a great a function on the terminal called RRG, the relative rotation graph. And what you can see is that as you have seen a rotation out of things like the Mag 7, which is tech, telecom, communication services, and consumer discretionary, that has benefited utilities. It's benefited healthcare. Now, the big question is healthcare's rally reflecting just the fact that it was very underloved, underowned, and very cheap? Or is it actually reflecting a more defensive bid within this market? We think it's more the former than the latter, not necessarily this is a market where everybody's looking for safety.
Cameron, I still think earnings matter. And I think we've had very good earnings this year. The second quarter, the third quarter, really strong earnings here. Are the earnings at a level that can support this market here, do you think?
I thought it was really interesting. A couple days ago, you had Max Kettner on, and he was arguing that you've seen earnings in the third quarter go up so much that now the fourth quarter is implying a sequential decline, meaning that the fourth quarter earnings estimates are likely too low, or at least are a very low bar to jump over. That implies to us that there's still room for 4Q earnings to be revised higher. That is usually a good environment for risk taking. Maybe not on a day-to-day basis, but usually that is supportive for things like equities to continue to rally.
We've been hearing a lot from retailers as of late, and it's been a bit of a mixed picture. But I mean, we did have Black Friday that just passed, and we saw a lot of strength in the consumer there. How are you thinking about the retail space right now in terms of investment opportunities and just more broadly the consumer landscape?
That Black Friday growth certainly was encouraging, but it came with a few important caveats. It is not inflation adjusted, which means that you have seen big price increases for certain goods. So it's not necessarily reflecting volumes, and in certain areas volumes were likely weaker because prices had gone up so much. And also you had this big surge in buy now, pay later. And the big question is, how much are people reaching and adding to leverage in order to be able to fund their spending? And what we have seen is that there is still room in aggregate for households to add to leverage, maybe not in some of the lower income side of things. But if you look at broader household leverage ratios, they're nowhere near where they were back prior to the great financial crisis, for example.
I can actually make some money in the fixed income market. In 2025 here, I mean, I'm looking at the IN Go function on the Bloomberg terminal. I'm seeing kind of mid to very high single digit total returns across the fixed income space here. How do you think about that?
Yeah, isn't it incredible?
Yep.
I mean, we've had rallies and everything, and for a while, munis were sitting on the sidelines, but they had a great November as some of those supply-demand dynamics became more favorable. I think the question as we go into 2026 is what's going to happen with the Treasury curve? Do we see upward pressure on longer-term bond yields because of what's going on with fiscal deficits, because of what's going on with sticky inflation? We're now at a 10-year Treasury that touched near 4% last week. That seemed very low given the pace of inflation that we have. So I think it's a question of, do we have that same kind of total return potential as we get into 2026, simply because the starting point is much lower yields today.
Mm-hmm. And as we've been talking about bonds, just the rate market more generally, of course, we do have the Federal Reserve meeting this month. What are your expectations heading into that meeting?
So we do think that they will cut, and that is what the market is pricing. And I think it checked this morning a 95% probability that we're going to get to cuts. We are going to get a cut. We do not think that the Fed, though, will give guidance as to what they want to do in 2026, meaning this Fed will not. It'll be a meeting by meeting. They won't commit to a rate path. But that may not matter as much if we get the nomination for who's going to be Fed chair, because what that creates the potential for is that shadow Fed kind of commentary. If we get, for example, Kevin Hassett coming in and saying, or being nominated as Fed chair and saying, hey, we're going to 3%, the market will price that in with greater certainty. However, there is a big caveat and catch there. If you get somebody like Hassett get nominated, the question is, can he rally the troops of the Fed to vote in line with what he is pushing for? And that remains a big question, simply because he's an outsider and probably has the perception of being the most politically captured candidate that Trump could choose.
Cameron, when you talk to your clients, how do you talk to them about alternative investments, whether it's private equity, private credit, hedge funds? Is that something that comes up a lot?
Oh, it's incredibly important, mostly because a lot of our clients can tolerate illiquidity, but we think it's really important to be highly selective within each of those asset classes. So take private equity, for example. Instead of going into things like high valued growth equity and large cap buyout, we've been focusing on things like lower middle market, secondaries, GP stakes, things that we have found to have a much more attractive return profile, less sensitive to the capital market cycle. We've been focusing a lot on venture over the course of the last year. We've been doing a lot of work in infrastructure, as well as more uncorrelated assets. So things that would fall a little bit more on the esoteric side of things like water rights and litigation finance. The idea being is that we want to make sure that our alternatives do provide a source of diversification. So if your alternatives are relying on something like the U.S. consumer and consumer lending, which some of the asset-backed finance does, you're not really getting the diversification you're going for.
Cameron, it's been a really interesting year as we think about currency, specifically the U.S. dollar. I'm looking at the Bloomberg Dollar Spot Index, down about almost 7% on pace to end the year with that decline here. How are you thinking about the U.S. dollar? Is this the place to be right now?
Yeah. Well, the dollar fell primarily at the start of the year and has now been flat for the last 6 months. And what you saw was the dollar poke its head up above the 200-day moving average back last week and start to fade lower. The question we have, is that a false breakout? What we're looking as international money market futures show dollar positioning. And what you can see is that they were deeply, deeply negative, deeply underweight at the beginning of the year, which coincided with the low in the dollar. That underweight positioning has now been closed, but there's still a lot of room for investors to get more long the dollar. So if you see a little bit more dollar strength, that could cause more dollar length in positioning, which could then feed on dollar strength, and thus we get more of an upside. But that still remains to be seen as the technicals still raise a few eyebrows.
what's your 2026 theme? Have you written something like that?
Oh man, so we play I like to go with the Price is Right kind of strategy, so that way we go last. If you want to win the Price is Right, it's really best to go last. So we always wait till the second week of January to publish our outlook, because what we like to know is what everybody else has said, and then we can get a sense of where consensus is. Call it cheating or call it wise.
So what do you, it seems like, I'm not sure what's changed here. I feel like we've got a decent earnings background. I feel like we've got a Fed that's cutting interest rates. I got my economy still growing. It feels like 2026 could be another decent year unless something crazy happens.
It also feels a little bit like Back to the Future, because the same questions or qualms that we could have about this market and this economy are the same today as we had this time last year.
Yep.
You could look at high valuations. You could look at concentrated equity positioning. You could look at the fact that peripheral labor market data is weakening, and does that turn into an even weaker labor market? All observations that you could make this time last year, you could make today. Do they become more accurate in your concerns today after the strong rally that we've had versus what they were last year?
All right. I don't know. It seems like a pretty decent backdrop for me. Cameron Dawson, we appreciate getting a few minutes of your time. Chief Investment Officer at NewEdge Wealth, joining us here. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Time for newspapers with Lisa Mateo.
You've been waiting for it. Okay, have you heard of slop bowl fatigue?
I have not.
It's a thing. Now you have. Now you will. Okay, so it's when you go to like the fast food, fast casual, and you stand in front of the counter and you point out what you want, and they have a bowl of either rice or lettuce, and they just slop everything inside of it. Okay, so people are apparently getting tired of it.
Really?
Think like Chipotle, Kava, Sweet Green, like they all slash their financial targets. So instead, what they're doing is they're choosing things with more texture, things like sandwiches or tacos. They can fill you up. They cost a little bit less. And Bloomberg spoke to Steve Ells. He's actually the founder of Chipotle. He left the company in 2020. He started this new counter company called Counter Service. They have a location in Manhattan. But he's saying, yes, they are a bowl-free zone. People want more handheld, and that's apparently the new trend. So,
it can be messy, I guess, but I don't know.
I just always amazed how much they put on it.
Yes.
I said I want guac, and it's like, guac.
That's the perk.
Well, the first time I was at Sweet Green, I had to be schooled by somebody because I didn't know how to order. And, I was the old guy holding up the line.
Oh, no.
Yes. So there was a young Bloomberg person behind me who saved me. So I think that person, she's like, sir, this is how you want to do it.
You learn.
Always looking out for one another here at Bloomberg.
Right. But I'm just the deli guy. I'm old school.
Fair.
Yep.
Okay, so you like the handheld, the sandwich or the go-to. It's easier to take.
Okay. We live in a part of the world where we have great delis.
We do.
So
True.
And you take advantage of it.
Delis and
pizza.
bodega.
Yep, delis and pizza. That's it.
That's all you got. Okay, so this one's interesting. Bosses are going to new extremes to get their workers to use AI. Okay, so for example, companies like IBM, they're paying cash. They're awarding points that are redeemable for gift cards. They're giving out merch, invitations to showcase their solutions at company events to kind of put them on a stage and present this. Because companies invested all this money into AI systems, but their workers are kind of hesitant. Because some of them are saying, well, AI is going to make their job disappear faster, so they don't really want to go, or they don't have the time for the training. Or some people are saying they don't want to share their AI tactics because that gives them a little competitive edge, So maybe I don't want to share it because I want to move up the ladder.
Back in the day when I was starting out in investment banking was I was a good modeler, so I could model really well and knew all the macros for the Excel spreadsheets and things. I felt like I had an edge there for 2 or 3 or 4 years. But then that skill became less valuable as you get further in your career. But I think AI, you have to embrace it, don't you? If you're a young person coming up,
that's the thing.
Have to.
I feel like you do.
You have no option at this point.
Yes,
exactly. So it's just interesting because they're giving bonuses for people who do it.
Wow.
So
Wow.
There's a brownie point.
Exactly. All right. So this one stuck out to me because we all have the smartphone, right? But this one is a trifold phone. Okay, so this is from Samsung. It's their first trifold smartphone, the Galaxy Z trifold. So basically, it has two hinges, and it collapses. It opens up to like a 10-inch display. So it's like a little mini tablet. Yeah, you got to look at the picture. $2,450. Okay, it starts in South Korea. That's where it's launching on December 12th, and then it'll kind of make its way to the U.S., China, Taiwan, Singapore, United Arab Emirates. So if you look, if you're watching YouTube, there you go. That's what it looks like.
That's kind of cool. I mean, if you want a bigger screen.
Right. I'm just afraid it's going to break.
Right. Is it like a tablet at this point?
It kind of becomes a mini tablet.
Right.
Yeah.
So overstimulating.
I don't know.
Well, if you're watching shows or movies and stuff,
that's
if you're
fair.
gaming.
Exactly.
Good
That's
visuals.
what
It's not about the phone anymore. This is basically a camera/TV that you can make a phone call on.
But do you fold it back up when you want to put it to your ear for a call?
Yes, you do. And it folds back up to the regular size.
Okay.
But actually, Huawei actually came out with the first trifold back in like 2024. But it's the first for Samsung, so kind of interesting. And I know people are sounding off on the YouTube chat, and they're saying, they're afraid that it's going to break. So
Yes.
that's an issue.
All right, not for the kids.
yeah.
All right, Lisa Mateo, newspapers. Thank you very much. We appreciate that. The trifold phone. I'm happy with my iPhones.
This is the Bloomberg Surveillance Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.